Today, we are asking the ultimate question about your money. Are you actually an investor, or are you just a gambler with a smartphone?
Oh, that is definitely the million-dollar question right now.
Right. Well, in this video, we are going to define exactly what an investor actually is, look at the completely hands-off defensive strategy, and then explore the deeply analytical, aggressive approach.
We are going to map out the entire blueprint.
Welcome to our channel, where we discuss finance and financial strategies designed to help you build strong financial foundations, stabilize your current finances, and support long-term financial growth toward financial freedom. If you need professional support with CFO services, account management, financial operations, and more, feel free to reach out to us.
We really love helping you guys out with this stuff.
Today, we are doing a deep dive into The Intelligent Investor by Benjamin Graham, specifically looking at the crucial difference between investment and speculation.
And since this is the next part of our ongoing discussion on this book, definitely make sure to check out the previous part for better understanding.
So, to kick things off, if you look at modern stock trading, it feels, well, suspiciously like a casino.
It really does.
You pull a supercomputer out of your pocket, you tap a glowing button, and suddenly you own a piece of a company. It is highly gamified.
Oh, absolutely. The friction is completely gone.
Right. Which makes me wonder, in a world where everyone with a brokerage app is automatically called an investor, we might have totally forgotten what the word actually means.
We definitely have. To understand what an investor truly is, we really have to look at Benjamin Graham's strict definition from 1934.
Okay, what did he say?
He wrote that an investment operation is one that, upon thorough analysis, promises safety of principal and an adequate return.
Safety of principal, meaning you don't lose your original money.
Exactly. And if it doesn't meet those exact criteria, Graham says it is speculation, period.
Wow. So Graham insists true investing requires what he calls a margin of safety.
Right. The margin of safety is everything.
Which essentially means buying an asset at a sufficient discount to its intrinsic value, so you have a buffer for human error or bad luck.
Yeah, that's a great way to put it.
It's like buying a wallet for $10 when, for a fact, there is a $20 bill inside. The market is just ignoring the cash right in front of its face.
That is a perfect analogy. That built-in buffer is what separates true investing from gambling.
Yeah.
Graham points out how dangerous the broad investor label is today.
Because Wall Street labels everyone an investor now.
Right. When financial media calls a day trader a reckless investor, it's honestly an oxymoron. Without that thorough analysis and margin of safety, they are just speculating.
But telling someone to completely ignore speculation feels incredibly out of touch today.
How so?
Well, if you ignored the speculation around tech over the last 10 years, you basically missed out on the greatest bull run in history. Isn't Graham's strict definition just a recipe for getting left behind?
That is a really fair point. But Graham doesn't say all speculation is evil. In fact, intelligent speculation is actually necessary.
Wait, really? He supports it?
To a degree, yes. Without it, untested startup companies wouldn't be able to raise the capital they need to innovate. The allure of a huge gain is basically the grease that lubricates the machinery of innovation.
Oh, I see. So the market needs speculators to function.
Exactly.
Huh?
The cardinal sin isn't speculating. The cardinal sin is speculating when you think you are investing.
Ah, lying to yourself.
Yes, minding that line is crucial.
Okay, so since unchecked speculation is the default trap for human psychology, how does a safety-first individual actually build wealth? How do we bulletproof a portfolio against human emotion?
That brings us to what Graham calls the defensive investor. He designed this framework for someone whose main goal is safety and, freedom from bother.
Freedom from bother, so they do not want to obsess over the market daily.
Precisely. They want a set it and forget it system.
Right.
Graham's core strategy here is a strict 50-50 split.
Between what?
Between high-grade bonds and leading common stocks. You put half your money in safe bonds and half in reliable stocks.
And you pair that with dollar cost averaging, right?
Yes, investing a set dollar amount regularly, no matter what the market is doing.
So it's basically a financial autopilot that ignores the market weather. But how does that protect you from yourself?
Well, the real magic is that 50-50 split acting like financial shock absorbers.
Explain that a bit more.
Okay, so imagine stocks soar, and suddenly they make up 60% of your portfolio. Getting back to your 50-50 target forces you to sell some stocks and buy more bonds.
Oh, wow. So it literally forces you to sell high and buy low.
Exactly. You are systematically taking profits from equities and shifting them into the safety of bonds rather than letting euphoria drive your decisions.
That structural rebalancing is genius.
It really is. Since the future of security prices is unpredictable, you can't control the market. You can only control your own behavior. This mechanism forces discipline.
So the defensive route is about building a system that runs itself. But what if you actually want to take the wheel? What if you want to actively beat the market?
Then you become what Graham calls the enterprising or aggressive investor.
And I am guessing they do a lot more homework.
A ton more. And they cannot rely on popular methods. You cannot day trade and you cannot chase hot stocks.
Because everyone else is doing that.
Right. Aggressive investors have to use sound but highly unpopular strategies. For example, finding what Graham calls bargain issues.
Bargain issues. What exactly does that mean in plain English?
It means finding heavily undervalued stocks, trading for less than their net current assets.
Wait, meaning the company is selling for less than the actual cash and inventory it has on hand?
Yes. It means the stock price completely ignores the company's real estate, its equipment, or any future potential.
It is a company the market has completely discarded.
Exactly. But buying a neglected, undervalued issue like that is often a very protracted, patience-trying experience.
I can imagine. It has to be incredibly difficult psychologically.
It is. It requires incredible discipline to look at a stock everyone else is laughing at, trust your own thorough analysis, and just wait.
Just wait for the market to eventually correct its pricing error.
Yep, which is why very few people actually beat the market long term.
So, to summarize all of this, protecting and growing wealth really boils down to intense self-awareness.
It really does.
Whether you choose the structural shock absorbers of the low-maintenance defensive route or that rigorous, psychologically demanding, aggressive route, you have to know who you are.
And above all, you must follow Graham's golden rule. Never, ever mingle your speculative gambles with your true investments.
Keep them completely separated.
Keep them in separate accounts and keep them totally separate in your mind.
That is fantastic advice. Well, here is a final provocative thought to chew on before you open that trading app again.
Let's hear it.
With algorithms and index funds making the stock market so incredibly efficient today, is Graham's aggressive strategy of finding deeply misunderstood bargain stocks even mathematically possible anymore?
That is a great question. Has modern technology made the enterprising investor obsolete?
Take a hard look at your current financial holdings today and ask yourself, are you truly investing based on Graham's strict definition of safety, or are you just speculating in disguise?
Something we all need to ask ourselves.
Definitely. Thank you so much for joining us for this discussion. Please remember to like the video, subscribe to the channel, and share this content so we can keep making these educational finance discussions for you.